Hi guys, in today's quick video we'll cover the six tax benefits of investing in real estate. So let's begin. Number one is depreciation. The tax code makes the assumption that rightfully so that after some time each property goes under wear and tear, and so they depreciate its value over time. Anywhere from 39 years or 27 and a half, depending on whether you're looking at commercial or residential property. We all know that this is not necessarily the case due to the power of inflation, as well as you maintaining your property and enhancing the valuation with certain value-add strategies that we've covered in prior articles and videos. And so effectively that expense is non-cash. You're not necessarily incurring those costs over time. And the impact of capturing that depreciation is that it effectively reduces your taxable income and therefore your tax liability. In another video, we'll also cover the benefit of cost segregation, which allows you to accelerate that depreciation. Now, you often hear that depreciation is recaptured at the time of sale, and that is correct. However, you still benefit by taking advantage of depreciation over time in the short run because you have the time value of money. The taxes or the tax liability that you saved in year 1, 2, and 3 are extra dollars that you can either put towards improving your properties or investing in other real estate properties that will produce cash flow and appreciation over time. So even though you're capturing that at the time of sale, and we'll talk about that in a moment, you still benefit due to the time value of money factor. Number two, which is a nice segue from number one, is the 1031 exchange. Now, we talked about recapturing depreciation at the time of sale and paying taxes on that, and as well as any capital gain that you produce. Well, the IRS code has a provision called 1031 exchange that effectively allows you to defer such capital gains if you exchange your existing property for a like-for-like one, meaning buying another real estate property of equal size or greater, which in effect allows you to defer those taxes until you decide to sell that property. And if you don't, and if you keep doing 1031 exchange after 1031 exchange, in theory you could defer those taxes forever until you pass away, and at the time your heirs inherit that property on a step-up cost basis, which actually reduces the tax burden for them as well. Number three is real estate professional status, which is effectively an individual who spends 750 hours or more in the real estate business and 50% more than anyone else, or more than 50% than anyone else. For that reason, it's very difficult for full-time W-2 folks to qualify as a real estate professional status. However, if you are married, filing jointly, and one spouse is able to qualify as a real estate professional or rep, then since you're filing jointly, your passive losses can still be offset against active income that the other spouse is generating just by virtue of the fact that one of those two spouses is a reps. Why is that important? Because you're enjoying better tax status. For example, like I mentioned, some of those passive losses generated through accelerated depreciation or depreciation overall can be used to offset your overall tax income liability. If otherwise you're not able to use passive losses to offset active income. But we can cover that in another snippet, because even if you're not reps there's still benefits. You don't lose those passive losses to the extent you're not able to qualify. You just carry them forward over time, and then you can apply them at the time of sale. Number 4 is the cash out refinance, which is effectively tax-free income. Why? Because you're doing a cash out refinance, you're effectively levering up or re-levering the property. Debt is not considered earned income and is such not taxed as such. You can then utilize those proceeds for additional capital improvements on your existing property to further increase its valuation, or you can buy more real estate and expand your portfolio. Number 5 is the rental income and capital gains tax. Now, because it's not earned W-2 income, rental income is not subject to Social Security and Medicare tax. And so long as you hold the property in long term, so flips wouldn't necessarily fall in that category, then any gains at the time of sale are taxed at the capital gains rate, which is lower, anywhere from 15 to 20%, depending on your income tax bracket level, versus the ordinary income of 35% or so. And last but not least, number 6 is the Homestead Exemption, which effectively allows you to deduct up to $250,000 if you're filing individually, or $500,000 if you're filing jointly, for a home that you owned and purchased and resided in 2 out of the past 5 years. So let's just say, for example, you purchased a property at $250,000, sold it at $500,000 a few years later for a $250,000 gain. So long as you resided in that home for 2 out of the past 5 years, you're able to deduct that gain and effectively upsize tax-free. As usual, we will always recommend that you consult with your own tax advisor or tax professional, because everyone's situation is different. Nevertheless, we wanted to share those top 6 strategies so you can keep them in mind and discuss with your tax professional on how they apply to you, if they apply to you, and whether or not you can benefit from those. So we hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.